You open two savings accounts side by side. One pays 5.20% APY, the other 4.50%. You pick the higher one, obviously. 12 months later, you check the numbers and the better account has left you almost $70 poorer in real terms. Not a bank error, not a scam, just three forces you probably never factored in, working together quietly all year. Start with the number on the tin. When a bank advertises 5.0% APY, that figure assumes you keep every cent of interest earned. But if you're a taxable saver, meaning your savings aren't locked in a Roth IRA or 401k, the IRS takes its cut first. The formula is brutally simple. After-tax return equals the nominal rate multiplied by 1 minus your marginal tax rate. For someone in the 22% federal bracket, that's 5.0% times 0.78, which lands at 3.90%. The advertised rate overstates your actual gain by more than a full percentage point before you've even touched a fee or thought about inflation. Why does the tax hit feel so heavy on savings interest specifically? Because the IRS treats every dollar of savings interest as ordinary income, taxed at the same rate as your paycheck, at whatever bracket you fall into, anywhere from 10% up to 37% federally. That's fundamentally different from how gains on long-held investments are taxed. Sell a stock ETF you've owned more than a year and most middle-income earners pay just 15% on the gain. Not 22%, not 24%. A saver in the 24% bracket who earns $500 in interest hands $120 to the IRS, keeping $380. That exact same $500 gain from a long-held stock ETF would cost only $75 in tax at 15%, leaving $425. $45 more for doing nothing differently except choosing the account type. So savings interest gets no preferential tax treatment whatsoever. It sits fully inside your ordinary income brackets, while long-term capital gains get their own lower schedule, 0%, 15%, or 20% depending on income. The top ordinary rate is 37%. The top long-term capital gains rate is 20%. That gap isn't a loophole. It's written directly into the tax code. But it means a savings account is one of the least tax-efficient places to earn a return. Knowing your bracket isn't just trivia, it's the single biggest variable in what your advertised rate actually means for your pocket. Taxes are force number one. Force number two is fees. And this is where the math gets counterintuitive fast. High-yield savings accounts, especially online ones, often attach monthly maintenance fees or minimum balance requirements. Those fees come straight off your interest, dollar for dollar, after tax. Run the numbers on a $2,000 balance. Account A advertises 5.0% APY, which sounds great, but charges a $10 monthly maintenance fee, $120 a year. On $2,000, you earn $100 in interest. Subtract $120 in fees, and you're sitting at negative $20. You literally lost money holding the higher rate account. Account B offers 4.0% APY with no fee at all. It earns $80, and you keep all $80. The lower rate account beats the higher rate account by $100. Compare those two accounts side by side and the fee structure completely inverts the advertised rate advantage. A 1 percentage point difference in APY on a $2,000 balance generates only $20 more interest, but a $10 monthly fee generates $120 in annual costs. Fees scale with time, interest scales with balance. On small to medium balances, fees almost always win that fight. The break-even balance, where the extra interest from the higher rate account finally exceeds the fee, for a 1% APY advantage and a 10 monthly fee works out to $12,000. Below that threshold, the fee-free lower rate account wins every time. Force number 3 operates even more quietly. Inflation. Inflation doesn't touch your account balance. It touches what that balance can actually buy. The approximation economists use is real return equals nominal rate minus inflation rate. If your account pays 4.50% APY, but inflation is running at 5%, your real return is approximately negative 0.50%. A $10,000 balance grows to $10,150 in dollar terms by year end, but priced at today's goods, that $10,150 only buys roughly what $9,750 bought 12 months ago. You've gained $450 in nominal dollars and lost about $48 in purchasing power. The account looks like it grew, your actual standard of living shrank. The inflation effect is especially insidious because it scales with your entire principal, not just your interest. When inflation runs at 4%, a $5,000 balance loses roughly $200 in purchasing power over the year, regardless of what interest rate you're earning. That $200 erosion has to be overcome by your after-tax, after-fee interest just to break even in real terms. And if you're earning an after-tax return below inflation, you are guaranteed to fall behind, no matter how impressively high the advertised APY looked in the bank's marketing email. Now put all three forces together in one real comparison. This is where the opening paradox gets fully explained. Two accounts, same $5,000 balance, same 22% tax bracket, same 4% inflation environment. Account A advertised at 5.20% APY, $8 monthly fee. Account B, 4.50% APY, no fee whatsoever. Account A earns $260 in interest. Tax takes 22%, leaving $280. Subtract $96 in annual fees, $106.80 remaining. Now subtract $200 in inflation erosion on the $5,000 principal. Real net, negative $93.20. Account A, the higher rate account, lost you $93 of purchasing power in a year. Now run the same math on account B, 450% APY, zero fees. Interest earned, $225. Tax at 22% takes $49.50, leaving $175.50. No fees to subtract, $175.50 stays intact. Inflation erosion on the same $5,000 principal at 4% is still $200. Same for both accounts, because the principal is identical. Real net, $175.50 minus $200, which is negative $24.50. Account B also lost purchasing power this year. Inflation was that high. But it only lost $24.50 compared to account A's $93.20. Account B leaves you $68.70 better off in real terms, despite the lower advertised rate. That's the full answer to the opening paradox. Lay both accounts side by side on every dimension that actually matters, not just the advertised rate, and the picture inverts completely. Account A wins on the headline APY. It loses on after-tax yield, loses on net of fee return, and ends up with a worse real outcome by nearly $70. Every single lever that moves real money flows in favor of account B once you get past the number on the marketing page. The sensitivity here is worth understanding because not every saver faces the same three forces equally. Fees hurt the most on small balances. On a $2,000 balance, a $10 monthly fee wipes out interest entirely. Taxes bite hardest for savers in higher brackets. A 37% bracket saver sees nearly 2/5 of every dollar of interest vanish before they touch it. Inflation hurts most when you're holding a large cash balance and earning a rate below the inflation rate. The larger the principal, the larger the absolute purchasing power erosion. Change any one of these inputs and the ranking between accounts can flip. The advertised rate is just the starting point. So what does it look like when you factor in tax brackets across the full federal range? Map every bracket against a 5% APY account and the after-tax yield slides steadily downward. A 10% bracket saver keeps 4.50%, a 22% saver keeps 3.90%, a 24% saver keeps 3.80%, a 32% saver keeps 3.40%, a 35% saver keeps 3.25%, and a 37% saver keeps just 3.15%. That's almost a full 1.4 percentage point difference between the bottom and top brackets from the exact same account. Two people looking at identical marketing materials are earning very different real returns based purely on their tax situation. There's also a threshold worth knowing, the balance at which a fee-bearing high-rate account finally beats a fee-free lower-rate account. That crossover depends on the APY difference and the annual fee. With a 0.70 percentage point APY advantage and a $96 annual fee, the fee-bearing account only starts winning above about $13,700 in balance. Below that number, the fee always consumes more than the rate advantage generates. Above it, the math flips back. The account that's genuinely better for you depends entirely on how much you have sitting in it, not on which number looks bigger in the advertisement. All of this points toward a single discipline. When comparing savings accounts, never compare advertised APYs. Compute one number, the after-tax, after-fee, inflation-adjusted net gain on your specific balance in your specific bracket at today's inflation rate. That single figure cuts through every piece of marketing and tells you what actually lands in your pocket. The formula isn't complicated. Take your balance times APY times 1 minus your tax rate, subtract annual fees, subtract your principal times the inflation rate. That's your real one-year outcome. Run it for every account you're considering, and the ranking almost always looks different from the one the bank wants you to see. The deeper lesson is about what the word better means in the context of a savings account. A higher advertised rate is better only if every other variable is identical. Same fees, same tax treatment, same inflation environment. When any of those differ, the higher rate can easily be the worst choice. The bank's job is to make the APY number look as large as possible. Your job, now that you know the three forces, is to translate that number into the one that actually reflects your situation. A 4.50% account with no fees can beat a 5.20% account with fees and a higher tax exposure by nearly $70 in a single year. Over many years, on a larger balance, that gap compounds into something that genuinely matters.